Today I'd like to speak about the super-deduction, which is a special allowance announced by the Chancellor in his budget in March to incentivize companies to spend on capital expenditure as we come out of the COVID pandemic. The Chancellor is keen that companies should spend money now in order to encourage growth. And the way he's incentivizing this is that for every £100 that a company spends on certain capital expenditure, for example, on equipment, fire alarms, furnishings, vans or security or similar, he will treat that as if 130% has been spent. So, for example, if a company spends £100,000, then on their tax computation, that will be treated as expenditure of £130,000, and at the current corporation tax rate of 19%, they will get a tax deduction of £24,700. Now, the reason why he's bringing this in now is because the corporation tax rate is going up on the 1st of April 2023 to 25%. So some company directors may have felt that it was better to defer expenditure to April 2023, and then they would get a higher tax deduction, a tax deduction of 25% as opposed to 19%. So in order to encourage us, company directors, to bring forward our expenditure, the Chancellor is giving us a 130% allowance, which translates to around the same tax deduction. Now, there are some restrictions on this. The expenditure has to be on items which are brand new. The period has to be from the 1st of April 2021 till the 31st of March 2023. You cannot spend money on capital expenditure for which a contract has been entered to before the 2nd of March 2023. That was the day of the budget. It doesn't work for cars, not for gifts, not for purchases from connected parties, companies in the same group, and not for items which are leased. Now, the government has, since the announcement was first made, changed that slightly, and where companies have leased buildings in which they want to claim for background plant and machinery in those leased buildings, then they will be able to claim this super deduction on that. Obviously, this applies to corporations only, to companies only, not to individuals. The claim for the super deduction cannot be deferred, so the period in which the company incurs the expense, that is the period in which they have to make the claim. The thing to look out for is that there is a potential clawback of the tax allowance which was claimed if a company would sell the asset in a subsequent period. So, for example, if the company bought the asset now and claimed the super deduction allowance, but sold it in 2 years' time or 3 years' time when the tax rate is either 25% or a marginal rate of perhaps 26.5%, and they sold it for the same amount which they bought it for, then they would have to repay the tax. So it could be that they would get an allowance now at an effective rate of 25%, and they might land up repaying tax at a rate of 26.5%. It's a bit complicated. If you think that's the circumstances which are going to affect you, by all means, be in touch and we can work it out. There is another announcement which was made together with this one, and that's to do with integral features. Integral features are long life assets on which the usual first year claim is 6%. And for this period from the 1st of April 2021 till the 31st of March 2023, the allowance has been increased to 50%. Normally, first year allowances would qualify for an AIA, an annual investment allowance, of a maximum of £1 million. The government has reduced that to a maximum of £200,000. And therefore, again, if there's a company which is considering spending a lot of money on capital allowances, on assets which qualify for capital allowances, they would want to consider carefully whether they want to claim AIAs, whether they want to claim the 50% deduction, or whether they want to go for the 130% deduction. And again, if this is something you're considering, be in touch and we can work out the best plan and the timing of when to buy the assets. A piece of advice that, because as we mentioned, there's a potential clawback of the tax which was deducted if these assets are sold, it's important to keep a list. So whatever assets you do buy now which qualify for the super deduction, keep a list on your system of the cost price, the item, so that when you do sell them, if you sell them, or if they're written off, someone can know how much to take out of that asset pool and how much tax to charge on that. Once we're talking about capital allowances, I would just mention that many company directors feel that if they're not actually purchasing capital assets, then capital allowances doesn't apply to them. Now, we have found that many companies have buildings which have been around for a while, which perhaps they purchased from somebody else, and which they never really looked into the fabric, the structure, the equipment within that building. And we have found that in many instances, capital allowances were never claimed. Now, we have a partnership with a specialist firm of capital allowances advisors, and for no charge, they will look at the buildings, they will look at the assets in your portfolio, and they will discuss whether they think there is a potential for a claim. If there is, they'll look at it. They will only charge you if they're successful in a claim, and you may be pleasantly surprised and have a nice tax deduction in a future year. If you found this episode useful, make sure you check out the other tax tips videos in this series. And if there's any aspect of something which I've mentioned which you want to discuss, feel free to be in touch.